You're about to hear my conversation with John Cook, portfolio manager and co-lead of the Mackenzie Greenchip team. We'll talk about the impact of the US election on Greenchip's investment universe, how policy changes on the horizon will influence the energy transition, and some of the more durable investment opportunities that John and the team are looking at today. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, VP of Investment Strategy and Portfolio Solutions. Today I'm joined by John Cook. John, thank you for joining the podcast today.
Yeah, glad to be here.
John, I'm speaking to you a little bit more than a week after the U.S. elections. We know that Donald Trump will be returning to the White House, but with him will be a Republican-controlled Congress. So I'm just going to dive right into my questions. Most would think that the U.S. is a major player in clean energy, and I want to know if that's the case. I ask because several Republican campaign promises were directed at undoing President Biden's renewable energy and climate-friendly policies. What do you think?
Well, let me start putting the scale of the U.S. clean tech market in perspective. So, the U.S. is about 25% of global GDP. And, in the MSCI world, it's up to 72% based on market cap. But when it comes to clean tech, global clean tech spend, it's only 15% of the global market. In some specific areas like solar, it's less than 10%. So I think putting this election in perspective in terms of our investment strategy, it's a small piece overall. In fact, since inception, Greenchip has never allocated more than 25% to the U.S. market. Now, that said, the U.S. does really matter in terms of setting policy, and we'll get into some of the specifics of what's helped and what's hurt. But I think it's important to also describe why the U.S. has been such a small piece of global clean tech spend. And that is quite simply that it's been blessed with some of the best fossil fuel geology, particularly shale oil and gas in the world. The U.S. effectively has better energy availability, security, and prices than almost any other developed country in the world, at least for now. And there's always a question of whether these shale riches turn into some sort of liability in the future. I think they will. They may become a fossil fuel trap for them. But right now, clean energy is a small piece of the overall energy investment that's taking place in the United States. If I might can I just share a few anecdotes with you? Because I think these are interesting. So I mentioned solar already. Think about it in terms of like other areas of our space, like high-speed rail. Mass transit moves people as efficiently as anything. The United States has only built 136 kilometers of high-speed rail in the last 30 years. China is up to 45,000 kilometers with 25,000 kilometers under construction. Spain has 4,000. Japan has 3,000. Canada's not much better when it comes to rail, but it's just an example of how far behind the U.S. is and how married it is to the internal combustion engine for transportation. And, another one would be the U.S. electricity system, and particularly transmission and distribution. And, you can ask anybody who lived through the Texas blackout of 2021, $200 billion in economic damages and directly led to almost 250 deaths. Some think that the death toll was closer to 1,000. As just an anecdote of how underinvested the U.S. is in the transition to electrification that's necessary. So when it comes to the election, I think we need to keep in perspective that the U.S. is a relatively small player despite the size of its economy in our investment space.
That's a great way to frame the rest of our conversation, John. Thank you. I'm going to stay with the election. So how do you think the election, with some of the changing policies, will have an impact? And with that, what are the investment opportunities that have already come up, or do you expect to come up on the horizon?
Yeah. So, you already said there was tremendous rhetoric on the election around the election campaign that was primarily negative related to energy transition, anti-wind, He wasn't so much anti-EV, although they've already said they would repeal the $7,500 EV purchase credit. I think there's going to be generally less carrots like the EV incentive that I talked about, and less sticks, which is regulatory policy. If I was going to be specific, though, I think most at risk would be offshore wind developments. So the executive office controls both oil lease and undersea offshore wind lease rights. And I think they'll be very quickly, that part of the transition will be slowed. I think anything to do with the hydrogen economy will go away. And although there's only sort of 1 in 10 cars sold in the US right now are EVs, despite that giant credit, I think the EV rollout is going to be much slower in the United States than in other parts of the world. The act that most focus on is Biden's improperly named Inflation Reduction Act, which provided significant grants to particularly battery and solar equipment manufacturing. That was very much targeted during the election as something that they would try and repeal. But during the Biden presidency, most of the actual investments went to Republican or swing districts, well over 80%. And I think they're going to find that even though it's a Republican-dominated Congress, it will be very difficult to repeal. In terms of tax credits, the two most important were called the investment tax credit, or the ITC, which helps solar development and battery storage development. There's a tax credit when you build these. And the other was a production tax credit, where you got a tax credit for actually producing green electrons. These two tax credits were extended through the last Trump presidency under a Republican government. And I also think they're relatively safe. So I think generally on the other side, you can expect some fossil fuel friendly policy. Now, that said, I don't think that fossil fuel production in the States will be controlled by the US presidency. I mean, fossil fuel production absolutely soared under Biden's government, despite his climate friendly policy. And I don't think it'll work the other way around. US oil, just the way it works, it's primarily controlled by Wall Street and the way fracking specifically works. So, I think we just had two analysts that were down in Chicago at an industrial conference, and they were talking to all sorts of CEOs in the manufacturing space, and they considered this election change a nothing burger. I don't know whether it's a nothing burger, but it has far less impact on our space, we believe, than you're certainly reading about initially in the papers. It sells newspapers, so lots of headlines around it. I think it is kind of a nothing burger.
So one last question on the US before I ask you questions outside the US, and that is, can you speak to the incredible momentum we've seen in Tesla stock over the last couple of weeks?
Oh boy, yeah, it's that is anything but a nothing burger. Since the election, the stock's up about 30%, 300 billion in market cap in 10 trading days. So it's a market cap. I haven't looked this morning, but as of yesterday, over $1 trillion. If you add up all the car companies in the world, Tesla is worth more than all of them combined. And just what's happened since the election, it's added the value of GM, Ford, Mercedes, BMW combined. This just doesn't make a lot of sense. Basically, the company is trading at about 100 times earnings. And those earnings are a little funky because they get tremendous amount of revenue that goes straight to the bottom line selling California EV climate-related credits. If you were to remove those, the stock is trading at about 130 times earnings. So it's certainly not a green chip type value play. And I think what it's saying a little bit is that Wall Street, or some in the investment community, believe access to the Trump presidency is worth hundreds of billions of dollars. And, we'll see whether that's sustainable, but there could be some real challenges in this relationship that Musk has with the federal government. And the ironic thing is, it looks like he's going to be involved in government efficiency or sussing out government efficiency. But the conflicts may come in that, Tesla had tremendous sales in China. And clearly this is an administration, including the last one, that's pretty anti-China. And a lot of those that have bought Teslas are sort of slightly left leaning, greeny. I'm not saying it's universal, but he may be disenfranchising his consumer base. So we'll see in time whether all this made sense. But it's a kind of crazy stock move. That's, by the way, Tesla is the only top 20 company in the MSCI ACWI that actually fits in our universe. So it's not a company we've ever owned, but it's something we watch closely. Of the 2,000 companies we own, only in our universe, only one is in the top 20 in the MSCI, and that's Tesla.
The speed and the magnitude of the move has been unbelievable. But I'm going to leave the US for a moment, and I want to have more of a global perspective. From your perspective as a portfolio manager, what are the global opportunities available today for investors interested in this space?
Yeah, I think there's you can divide them into different buckets. And I'll start with the negative ones actually quite quickly, because I think in the last year, a number of technologies in our space sort of proved to be uneconomically competitive. There was lots of hope, but as they matured, they just didn't really take off. And I would include in that, things like hydrogen, the hydrogen economy without some sort of a carbon tax. It just doesn't seem to economically make sense. Offshore wind, it's still unclear that it is going to be competitive. And despite what I said earlier about Trump's targeting potentially offshore wind in the United States, it's really not clear to us that it was competitive. Then I would say there's another group of businesses that are just in a poor place right now, but I think long term are going to be fine, like the electric vehicle sales and Western OEMs in general, OEM vehicle manufacturers. That's a tough space. Solar is going through a tough period. Solar growth has been incredible, but there's too much manufacturing. And that's something that I think will get cleared up in 2025, maybe early 2026. And the valuations are phenomenal. But then there's other things that are working incredibly well. Like, and this may surprise some, but coming back to my comments about the US grid, well, around the world, those that manufacture and sell electricity grid equipment are having a year. To give you some examples, like as of yesterday, Siemens Energy was up in the last year, 282%. They make three distinct products related to our space: wind turbines, power equipment, which is related to the grid, and gas turbines. Almost 300% in 1 year. Hitachi, similar type industrial business, up 90% in the last year. Mitsubishi Electric up 33%. Cable manufacturers, like the actual wires and transmission company we hold, Nexans, up almost 60% in the last year. Another area that's working really well, and it's kind of a rebound from some poor performance in 2023, is rail running stock. As I said earlier, moving people by trains is far less, makes far less of an impact on the environment. Companies like Alstom, one of our larger holdings and a long-standing holding, is up 80% this year after being one of our worst performing stocks last year. And both Alstom and Siemens Mobility are showing very strong back orders right now, as long as 4 to 5 years of back orders for trains. So there's parts of the economy that are operating really strongly. So if I was going to recap, there's a few technologies that are proving not to be where we hope they would be. They may still work out. These are not areas that we traditionally invest in. There are those that are kind of in down cycles where there's tremendous valuation opportunity. We are sticking with those, and we think there's lots of upside in the future. And there's those that I just mentioned that are performing extremely well.
That's great, John. I have some follow-up questions for you based upon what you just shared with us with regards to high voltage equipment, electrification. Can you give us some more detail on what's really driving this demand? And is it really is it going to be a 1-year phenomenon, or is this something that could be durable?
Yeah, I think this is very long term. So I'll talk more about developed market transmission for a second. So in emerging markets, they're building it for the first time, and there's nowhere near enough. There's still, believe it or not, 1 billion people on this planet that don't have access to electricity. So there's lots of developing market growth. In developed markets, we've been living for 50 years off a transmission dividend that our forefathers built for us. and it needs to be replaced. The average transformer in the United States is over 50 years old. So there's just that refurbishment of electricity equipment. The second thing is there has been globally almost 3% demand in electricity as we install heat pumps, increase EVs, which are doing much better in other parts of the world than I painted in the United States. We're going to need more electricity. And then, of course, this year, what was really highlighted, which is so important, is the huge electricity requirements for data centers related to AI. And it's all creating sort of a perfect storm of demand for transmission equipment, the engineering firms and construction firms that build this, the cabling, and so on. And in terms of AI, that would be the one thing that maybe there's a little bit of overexcitement this year. I don't know. It's impossible for me to predict that. But the first two that I talked about are already overwhelming demand on the equipment. So I think it is anything but a one-year trend.
That's excellent. I want to follow up on a couple of other items that you shared with us. With regards to solar, you mentioned that there's a needed shakeout maybe on the manufacturing front. Could you give us a little bit of detail on why that's needed?
Sure. So we've seen solar develop on many fronts. Like as many listeners will know, the price of solar has dropped spectacularly in the last 15 years. It's probably they call it the learning curve. It's probably the greatest drop in price, and it's so much cheaper to build solar than any other type of electricity generation right now. Even solar plus short-term storage using batteries is turning out to be cheaper than natural gas and coal in many parts of the world. So tremendous opportunity and demand growth. Last year we did 360 gigawatts of installation. That's up from 3 gigawatts, like 100 times anyways, where we were in 2007. So tremendous growth. And along with that growth came overinvestment in manufacturing capacity, primarily in China. So right now, if the world will install this year about 400 gigawatts, in China, there's probably manufacturing capacity for 700 to 900 gigawatts of solar equipment. Now, a lot of that is, a couple generations back. And these are the smaller players that didn't invest in the latest technology, the most efficient technology. And they're the ones that are most susceptible to bankruptcies. We've already seen 6 or 7 of those go out of business. What I think is coming in China is maybe one of the biggies. There's 5 biggies that account for about 80% of solar manufacturing. One of those to go. And then I think that we're back in a balanced state between demand and production. And the ones we own, we feel very comfortable. We own 2 solar module manufacturers. They're in the top 5. They have solid balance sheets. We have no worries at all that they're going to go bankrupt. They're so cheap right now. The important thing is just to be a little bit patient. So it's a smaller piece of the portfolio for us, but it's one that we think we can see tremendous upside when this consolidation in the marketplace happens. The one message that's so important, though, Regin, is solar is not going away. If you look at renewable electricity development, which includes wind, but was primarily solar, it's multiples of all the other generation type investments in the last few years. It's just a massive business now.
One other follow-up question, John. What do you make of the demand for EVs in the US? You've referenced EVs throughout our conversations, and demand in the US has trailed that of other markets. Is it the choices that consumers have, or is it just a function of being attached to the internal combustion engine?
It is a complicated situation to unpack because part of it is political. You've got a very bifurcated political group in the States, and EVs have been associated with climate and green policies and one side of the political divide. And so part of it is seen as an identity purchase. The second factor is EVs right now are not a perfect technology. They do cost a little bit more. They cost a lot more in the US because the US doesn't have any of its own battery manufacturing. They're going to cost a lot more in the future in the US because of these tremendous tariffs which Biden just put on to EVs. There was already some tariffs. He's put 100% tariffs on EVs coming from China, which is quite frankly, going to slow the uptake of cheaper EVs. So they're quite expensive. And then, of course, there's range anxiety and people don't have the infrastructure in their homes to charge them and whatnot. But you do have to compare the US to other parts of the world. In Europe, it's twice as many car purchasers will buy an EV than in the US. And in China, it's half of car purchasers are buying an EV. And parts like I was in Norway in September, 80% of cars on the road are already EVs. So the US is miles behind. And as I said earlier, for a country that produces 13 million barrels of oil a day and may, in my opinion, be near peak oil production and consumes 20, I think this is a long-term risk to the US that they're moving slower through the transition than many other parts of the world are. But, we'll see. History is a very difficult thing to predict.
Thanks, John. My final question for you. I opened our conversation referencing the Republicans taking Congress and entering a second Trump presidency. I'd like to finish our conversation by asking for your thoughts. What do you think the implications of a second Trump presidency might have for geopolitics and the broader global economy?
There is so much uncertainty already. Let's just say before Trump comes into office, there is so much uncertainty in the world right now. The bifurcation between the United States and China, India, Russia is well underway, Iran, and so on. So it's a complicated world. I think there's going to be even more protectionist policy against China. This isn't new, but it's been well documented through the entire campaign that Trump not only plans to put more tariffs on China, but tariffs on everything coming into the world. And so I think whether this was just related to Trump or not, I would go back to a piece I wrote at the beginning of the year where we said we thought inflation was going to be stickier than many seem to think right now. And I think 2024 saw some pretty significant central bank cuts around the world. But often, 2 weeks ago, Thursday, we saw the US central bank cut rates at the same time that day, mid and long-term bonds yields were increasing. So the bond market seems to be saying that inflation is going to be higher too. And if you think of higher tariffs, deportations, lower taxes, all the things that incoming President Trump was saying when he was on the campaign trail, they all sound inflationary to us, on top of a period where we're not investing nearly enough in, copper production, in the manufacturing of so many of the inputs that we need. To us, it all spells higher prices. And when you get higher prices, as we know, you see even more geopolitical instability. So I think we're heading into quite a difficult time geopolitically. And because of the uncertainty, the way that Trump tends to, historically anyways, operate, he thrives off this, uncertainty. I think it's going to be very difficult for us all to get, find that North Star of where the world is heading.
Okay. Thank you, John. Thanks for your time. We had a wide-ranging conversation today, but I quite enjoyed it. And I really appreciate you making the time to share your perspectives with the audience.
My pleasure, Rajan.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.